day, everyone. Thank you for joining us once again here at Seaford and Brew for our economic briefing. For this briefing, we want to review over the Fed statement that came out earlier this week and just look at the potential impact that we're going to see on community banks inside their net interest margin. So let's dive in to that Fed statement. A lot of the normal language that they had about the COVID-19 and how that has had a tremendous impact on both the United States economy as well as worldwide. But a couple of things I do want to point out is their new policy that Chairman Powell went over at the Jackson Hole, where they're looking at the inflation more of on an average basis in terms of looking at it at 2%. And we know that they did keep the Fed funds rate between 0.25%. That was expected. But listen to what they say here. They said expects to be appropriate to maintain this target range until the labor market conditions have reached a level consistent with the committee's assessment of maximum employment. And they add inflation has risen to 2% and is on track to moderately exceed 2% for some times. And that's a significant statement. That means, according to their statement, that they're looking at maintaining this very low level of interest rates well into the future until we see a maximum amount of employment as well as that price stability, allowing that inflation number to get up above 2% for some time. That's what they're expecting as far as how long they're willing to let these rates down this low. Not only that, but they do say in addition, over the coming months, the Federal Reserve will increase its holdings of Treasury securities and agency mortgage-backed securities at least the current pace, which is currently about $120 billion a month, to sustain that smooth market functioning and help foster accommodative financial conditions. So they're looking to continue this increase in their balance sheet at that $120 billion a month. That's buying $80 billion in treasuries as well as $40 billion in mortgage-backed securities. Now, when they went to take the vote, there were two dissenting individuals that voted against this action, Robert Kaplan and Mr. Neil Kashkari. And it's not that they didn't want to maintain the rates low for a period of time. They wanted to make sure that people were clear in terms of how long they were willing to keep these rates at this level. In fact, Robert Kaplan says, who expects that it will be appropriate to maintain the current target range until the committee is confident that the economy has weathered recent events and is on track to achieve its maximum employment and price stability goals as articulated in the new policy strategy statement, but prefers that the committee retain a greater policy rate flexibility beyond that point. So he wants to have a lot of flexibility to even remain below low for even longer. Similarly, Neil Kashkari says who prefers that the committee indicate that it expects to maintain the current target range until core inflation has reached 2% on a sustained basis. Now the question could be, well, what does he indicate as a sustained basis? Is that a month, 2 months, 3 months, a half a year, until he's willing to then tighten up that policy and raise rates? So we did have some indication that we are going to be down here for a very long time, and we saw that in their projections. If you recall, they give their projections 4 times a year, and here we see them as of September. Notice the GDP in terms of the growth for our economy for 2020, looking at the September projection at negative 3.7%. That's an improvement from where we were back in June, where they had that expectation at negative 6.5%. And we'll see how that impacts that shape of the recovery in a minute. But look where they put 21, 22, and 23. Notice they do reduce down their expectations in 21 from 5% to 4%, and then also in 22 from that 3.5 to 3%. So they continue to slow down that growth expectation in the coming years. And then for the first time, they released the 2023 numbers, and they continue that slowdown in that growth, looking at that to be 2.5% out in 2023. So growth expectations starting to wane in here beyond the tremendous growth we expect to see in the third quarter of 2020. In terms of unemployment, looking to get down to 4% by 2023, and then inflation not reaching 2% until 2023. So build that all into their expectations on the Fed funds rate, and we see that Fed funds remain very low throughout this projection period. So that's another 3.25 years we can see being down at this level. And that's something that we need to be prepared for as the ALCO when you start your discussion about rates on loans as well as deposits. Overall, when we look at the economy, we saw that big hit in the second quarter where we saw the GDP fall by 31.7%. We can see the June coincident index put out by the Philly Fed. Most states here going negative for that June period, that 3-month change. In fact, all of the United States was down about 5% for that 3-month period. Push that into the July map. July map looks totally different, which is what we expected. Most states showing big positive numbers in their growth in GDP for July. We anticipate August to be a similar map and then potentially start to pull off a little bit in the September map. When we map out the Fed's projections in terms of the shape of the recovery, we can see not a V-shaped recovery, but more of a swoosh in here where we have a fairly significant increase in that quarter after that fall, so the third quarter, and then we start to see that growth kind of moderate out. But notice in this graphic, this goes out to 2022, we do not breach that line in terms of where the economy was, the GDP was at in 2019, and then growing it by a 2% growth rate. So we're still underneath that line, indicating a full recovery still will not happen, even going out to 2022. When we see the aggressiveness on the Fed with their balance sheet growing up to $7 trillion as of last week, and as they move forward as of this week, and as they move forward in here, we expect that to continue to grow with their asset purchases of treasuries and mortgage-backed securities, but also continuing to implement the various lending products that they have out. In fact, we could, if they were to fully implement all their lending facilities, we could see that balance sheet get up to or over $10 trillion. And that's going to keep rates low on the long end. And that's the big difference that we're seeing with this recession compared to the great financial recession, where we had Fed funds down at this level for 83 months. but that long end of the curve, looking at the 10-year Treasury, maintained above 1% throughout that time, closer to an average of 2%. And now we're down here with the expectations that the 10-year is going to be sub 1% for a significant period of time. And that's just going to create that margin compression for our financial institutions as we move forward. We continue to tell our banks the need to reduce down costs, both on the interest side, looking at lowering their deposit rates, as well as the non-interest side, looking to become more efficient, is paramount in here, with the addition of looking at credit and making sure your credit is on par and that any new loans that you're writing today are solid credits. Because we're going to start to see now with deposit rates, they have moved down. We've seen the aggressiveness there. Now we're going to start to see that change in the yield on earning assets with all of the refinance activity that's been going on. We will start to see that level of yielding earning assets come down over the next couple of quarters. We look forward to reporting more on that as we move forward, and we expect a reduction in the net interest margin once again when the third quarter numbers come out in November. Well, that's what we have for you today. We look forward to speaking to you again shortly. Have a great day, everyone.